Many people believe diversification simply means having more than one income stream. But diversification can be much deeper than that. Because concentration does not exist only in employment. It can exist in several dimensions at once. Up to this point, we have focused mainly on income concentration. Now we expand that idea. True diversification is multidimensional. You can diversify income, yet still remain concentrated in other areas. For example, you might have two income streams, but both depend on the same industry. If that industry slows, both streams weaken. That is sector concentration. You might hold investments, but all in one geographic region. That is geographic concentration. You might own several assets, but all of them are difficult to convert into cash. That is liquidity concentration. Diversification is not about complexity. It is about redundancy, and redundancy reduces fragility. Let us simplify this into three structural pillars: income, assets, liquidity. If one pillar weakens, the other should provide support. That is structural resilience. Now pause for a moment. Open your workbook. Write down your income sources. Then write down your asset categories. Then write down your liquidity sources. Look at those three lists together. Do they rely on similar economic drivers? Or are they structurally distinct? Diversification does not require owning everything. It simply requires avoiding single-point failure. Single-point failure occurs when one disruption affects several areas simultaneously. For example, if your employment, investments, and property exposure are all tied to one industry, a downturn in that sector affects everything at once. Now reflect quietly. If your primary industry slowed significantly, which of your assets would remain stable? And which would be affected? Write that honestly. Diversification is not fear-based. It is design-based. You are not predicting crisis. You are reducing dependency. Behavioral finance research shows that many people diversify within categories, but not across structural drivers. For example, owning several stocks in the same sector can feel diversified, but structurally, it may not be. The objective is not maximum spread. It is intelligent spread. Spread across economic drivers. Spread across liquidity layers. Spread across income sources. In the next episode, we will introduce a simple but powerful framework: the capital allocation grid, a way to decide where surplus capital should flow, based on structural balance, not impulse.